A very good afternoon, everyone, and welcome to our September webinar, Finding Future Growth Stocks in Time of Turmoil. I've got three graphs that I'm going to show you. We've heard Chris talk about oil prices and what he feels is going to affect. And we're looking at the crude oil price from back in 2014. We saw it fall from about 110 down to about 44. This is going about a day ago when I took this chart. The next graph I want us to have a quick look at is the US Fed funds, which is the US interest rates. As you can see there, they started dropping off late 2007 into 2008. We haven't heard or seen an increase since mid-2009 up until, well, we don't know as yet, but up until we hear what they have to say today. And the last one, which Greg mentioned as well, is just the Chinese stock market. We've seen it go up and peak up until April, May this year, and it started to come down. I guess the question I have for our attendees today is quite simply, I'll just run a quick poll and find out. I want to find out which of these trends you guys think will actually impact the ASX most over the next 12 months. So we've got a few votes going on. We've got about half the attendees, half of the 500 people that are with us today voting. So we're waiting for the other half. It looks like 39% of our attendees today are saying the rising US interest rates will impact the ASX market the most. Very few people think the commodities will be affected by oil prices. It looks like everyone thinks our neighbors up north, China, will impact this ASX the most. Greg, let us know, which stock do you think will be impacted the most by the Chinese stock market, or which industry? And then if you can actually be stock specific, that would be brilliant.
Sure. Okay, in terms of the industry, I think the industry most at risk from, and when we talk about the Chinese stock market, remember I'm talking about probably more the Chinese economy as well, and as much as the Chinese stock market represents the economy, we'll just group it together. But I do think the big risk for Australia is in the banking sector. The reason why I say that is when I was talking before, the Chinese economy has been slowing down for, well, nearly 4 years now. The initial slowdown was felt in the resources sector. So you saw, the big miners, iron ore price, coal prices falling. The mines and metal index has fallen about 60% from its peak. So we've already seen that the China slowdown has had a big impact on the commodity sector. I think it does take a long time for that to work its way through into the heart of the economy, which is the banking sector. And Australia is a very financialized economy, and part of the offset of the China slowdown has been lower interest rates, which has ignited a housing boom in Australia, and that's created a big demand for finance, a big demand for financial services, mortgage growth. And obviously the banks are very exposed to that and have done very well over the past few years from lower interest rates and higher house prices. In my view, if China does continue to slow and slows more than what the market currently thinks, and the last couple of months, I think the market has probably sat up and taken a lot more notice of China than what it has in previous years. And in previous years, the view has been that Chinese authorities know what they're doing, they'll do a managed slowdown. And I think that attitude started to change in the past couple of months. My view is that that'll affect the banks purely because of the lag flow through of lower Chinese growth, lower income growth on Australia's national income, which will at some point sap demand for rising house prices and demand for financial services. Now, when I talk about the banks, I always like to look at the biggest bank, which is the Commonwealth, to see how it is affecting the sector. And if you look at the share price of Commonwealth Bank, most people would probably be familiar that the share price has moved from, I think, around $96 back in the peak of March to it's around about $74 today. So there's been a decent move in the Commonwealth Bank share price. You've also got APRA's regulatory controls kicking in, which means they're going to need to hold more capital, which means more shares on issue. And I think the biggest risk going forward is whether the banks can maintain those strong dividends that they've been churning out for the past couple of years. If there is any increase in bad debts, if there's any increase or slowdown in revenue growth, then I think the banks are at risk of having to maybe pare back their dividends a little bit. and that will have an effect on share prices. So what we've seen in the past few months, bank share prices are now in a downtrend. I take that as being that the bank bull market is over for the time being, and the market's reassessing their growth prospects. And if you do see weaker than expected growth in China, if you do see more concern about China's authorities to manage their slowdown, I think the banking sector will be the main sector that takes the brunt of those concerns.
Generally, Shepard, I do share those same sentiments. However, just to provide a bit of variety, I will focus in on a different industry. I agree with Greg's sentiment that really what we're talking about here is more the Chinese economy than the stock market per se. The volatility on the Chinese stock market's not really going to have a huge direct impact on businesses in Australia, but to the extent that that reflects declining confidence in the Chinese economy, then that can indeed have an impact. I noticed just last weekend some data was released that showed the slowest growth in fixed asset investment for 15 years in China. What that means, of course, is that demand for raw materials is being reduced, and companies that are earning a lot of their revenue by selling into China may indeed be affected by that, as they have been over the last couple of years, but I see that may well continue into the future. So if I can go into Scaffold now and maybe just pull up that old chestnut BHP and have a bit of a look, just as a bit of a bellwether as to how this trend may well be impacting on the Australian stock market, which of course BHP makes up a big part of our main indices. So what I'll do here, Shepard, is I'll just flick over to the earnings of BHP, and what you can see there immediately is that from 2011 onwards, the earnings have been in a steady decline, and indeed they're forecast to continue declining through into 2016. Then analysts are saying that it'll start to turn around. Looking at that, there's a couple of things that stand out to me. One, of course, is just the obvious trend, which is a negative one, a declining one. But a key point is if we look here at these forecast figures, you can see those sort of golden coloured halos, and what they represent are the minimums and the maximum forecasts for these earnings in the coming year. So you can see that, for example, in 2016, there's an average forecast of $1.06, but that it ranges from 40 cents through to $2.17. And likewise, in the following years, there's a very wide spread in those forecasts. And what that says to me, and there's 20 analysts covering this stock, so it's not just the opinion of one or two people. What that says to me is that really there's an awful lot of uncertainty as to what's going to happen in the coming years. And when you've got that level of uncertainty, that's going to impact, it's risk. There's no other word for it. It represents a high level of risk. So, whilst the analysts are saying that it may well turn around in 2017 and 18, there's a fair bit of uncertainty associated with that. If we go across here to the capital history screen, you can see the return on equity, which is represented by this blue line. Again, it's been declining considerably. It's forecast for 2016 to come in at 6.6%. Obviously not a very attractive number. So I think, whilst we've already seen a major impact from China on the resource stocks, I think that trend is quite likely to continue for a while yet. And the other thing I was going to just highlight to people, if I go across here to this forecast updates chart, what this is showing us is the change in analysts' not the change in analysts' forecasts, but the change in valuations, which are largely being driven by those analysts' forecasts. And you can see over the course of the last 12 months that has clearly been declining. So that orange line that goes across the page represents the valuation at the different points in time over the last 12 months, and the sort of grey shading represents the share price. And it's a very clear trend that analysts' expectations have been lowering steadily throughout the year, and there's a reasonably good likelihood that those expectations will continue to fall in the foreseeable, over the next little while at least. So that to me is one of the great areas of risk coming out of China.
Okay, well, look, very, very quickly, I just want to turn my attention to a question from one attendee. Alan says a small percentage of the Chinese people actually invest in their stock market. Why then is the market so volatile?
I'll make a few comments and maybe Greg would like to add to it. One of the things is that the Chinese stock market is driven by retail investors. In Australia and many developed markets, there's a much greater proportion of institutional investors in the market. And what that tends to mean is I hesitate to use the word, but a higher level of maturity when it comes to investing. One of the things that we witness in China is that there tends to be a bit of a get on board, things are looking great, you mustn't miss out. And then that quickly flicks to panic, run away, oh no, the sky's falling type of sentiment. And hence you see those great volatility. And that picture that you put up earlier, Shepard's kind of really summed it up with that gentleman with the expression on his face of sheer terror as the market was plunging before his eyes.
Yeah, look, I'd agree with that completely. And the analogy I'd probably use is that people look at the Chinese stock market in more like a casino to try and make a quick buck rather than a long-term wealth-generating machine, which I guess it's seen to be in more developed markets by the majority of people. So yeah, I agree with that completely.
If you have any questions, feel free to give me a call on 1300 Scaffold, or just send me an email at team@scaffold.
Investing in shares can be rewarding when you do your research, but it can also take up a lot of your time. There's so much information out there. How do you quickly sort through the companies worth investing in and those to steer clear of? Scaffold is my research tool of choice. It tracks and reports on all ASX listed companies, plus thousands of global stocks daily, helping me decide which stocks to buy and sell. I can quickly filter through the reports to get the information I need. The rating system is like a set of traffic lights for the stock market. Green is good, orange is caution, and red is don't go any further. Scaffold's top stock choices have been highlighted for their outstanding performance by Money Magazine. With Scaffold doing the work for me, I have the confidence to make investment decisions without having to spend hours sifting through financial data. Now you can take control of your time and your portfolio. Why not take Scaffold for a test drive today?